Andy, over 100,000 natural resource portfolios. And grading those portfolios has given me tremendous insight into the few things that speculators get right and the plethora of things that speculators get wrong. But most of what they get wrong comes down to three things. They aren't contrarian, which is to say they wait till a sector is in favor and hence expensive before they buy it. They need the price action to justify the narrative. The second is related to that. They're fad chasers. Uh, Maybe I'm saying the same thing in number one or number two. They don't do the work. I ask investors and speculators to limit the number of speculative stocks in their portfolio to the number of hours per month that they're willing to spend studying their portfolios. I've graded thousands of portfolios with more than 50 speculative names in them. And I know that not 1 in 100 of those speculators spends 50 hours per month studying their stocks. And when I say studying their stocks, I don't mean watching Rick Rule videos or reading the Northern Miner. I mean reading quarterly reports, reading resource statements, reading insider filing statements, reading 43101s or pre-feasibility studies or bankable feasibility studies. I mean working. The third thing is that most investors have a time preference, which is unrealistic. Many investors invest around a theme, say uranium, or say silver, or say copper, that likely has a 5-year expected course. Many others speculate on exploration outcomes that might take 18 months to mature. And despite the fact that these investors are investing in identifiable and accurate narratives, they employ very short-term tactics. If you are investing in a 5-year narrative and you have a 3-month time frame, you're almost guaranteed to fail. The greatest part of my financial success, other than risk tolerance and being willing to work, is that I got old. And I came to understand that I needed my time expectation to conform with what was required. I needed to be able to experience compounding. Even on the speculative side, what I learned, and it actually surprised me, is that over 50 years, the speculative stocks that I enjoyed tenfold or more returns on generally required 5 years to enjoy those returns. And in almost every case during that 5 years, the share price in question fell by more than 50% at some point in time in that 5 years. So in addition to being patient, you have to be tenacious. So that was the point of that speech. The point of the speech was that we are in a period now where people hate junior resource stocks. We're in a place now where the people who are left in junior resource stocks are fad chasers. They're anti-contrarian. We're in a place now where people's investment strategy is, quote, got a hunch, bet a bunch. They aren't willing to do the work. And we're in a place now where all kinds of people who don't know anything about trading consider themselves to be traders rather than speculators. If you address those 4 things within your own character, there is no sector that I know of that has a better potential risk to reward than the junior miners. Let's start, though, with the headline risk. The sector itself, the whole sector, sucks. Let's get that clear. If you merge every junior miner in the world, there's probably, 2,500, 3,000 of them, into one company. We'll call it Junior Explorco. In a very, very good year, that company, the industry, would only lose $2 billion. They'd only lose $2 billion because they couldn't raise too much more. In a bad year, they could lose $5 or $6 billion. They would call that a good year because they raised that much money. But the point of this at the beginning of the exercise is your listeners have to ask themselves how much money they would be prepared to invest in a company that lost $2 billion a year. Would they invest 8 times losses or 12 times losses? In a bull market, would they invest 15 times losses? When they're sick with that number, then they're ready to go. Because a subset of those companies, 5% of the issuers, maybe 10% of the issuers, generate so much value that they add legitimacy and even luster to a sector that loses $2 billion a year. The game then is how to separate the wheat from the chaff. How to know enough that when the stock that you've done work on declines by 30 or 40 or 50% in price without declining in value, that rather than being shaken out and selling at a panic bottom, that you understand that the value is increased and you buy more. That's the game. And the reason that I said to the people in that audience that they had no excuse not to make $1 million or more in 5 years is because they'd taken the first step. They had invested in themselves to come to this conference in Vancouver, the epicenter of junior mining finance, and invest in themselves. For those people who were willing to do the work, who were willing to enter now, this is truly, truly, truly a spectacular time. But it's only a spectacular time if people are willing to examine themselves and examine their reaction to the risks that we just enumerated.